The most confusing moment in any financial cycle is when the numbers say strength, but the system underneath says something else, and that is exactly where the US dollar stands right now. Headlines talk about a dollar rally, charts show upward movement, and many people assume this is proof that the dollar's dominance is safe. But history warns that rallies are often the most misleading phase of all. A currency can rise not because it is healthy, but because everything around it looks temporarily worse. This is not a new pattern, it is a recurring one. In moments of uncertainty, capital doesn't move toward the best system, it moves toward the least uncomfortable option. The dollar benefits from this reflex. When global markets feel unstable, investors rush toward familiarity, and the dollar still represents liquidity, depth, and habit. But habit is not the same as strength. The rally today is driven by short-term forces, interest rate expectations, relative economic performance, and fear elsewhere, not by long-term structural balance. History shows that when currencies rally late in their dominant cycle, it often creates false confidence that delays necessary adjustments. The British pound experienced similar rallies after World War I, even as its global influence was quietly shrinking. The numbers looked reassuring while the foundations weakened. The danger is not that people misunderstand weakness, it's that they mistake relative strength for absolute security. A rising dollar does not erase debt, it does not reduce long-term obligations, and it does not restore trust once confidence begins to fragment globally. It only masks pressure temporarily. This is why financial history is filled with moments where strength appeared right before influence faded. Rallies calm the public, silence critics, and reinforce the belief that nothing fundamental needs to change. But markets don't reward appearances forever. They eventually respond to structure. And structure is where the real story of the dollar is unfolding quietly, beneath short-term movements. If rallies can hide weakness instead of proving strength, then the real question is not why the dollar is rising today, but what this rally is preventing people from seeing about tomorrow. If a rising dollar can actually delay recognition of deeper problems, then what exactly is propping it up right now? And how many times has history shown that late-stage strength is the most dangerous signal of all? When people hear that the dollar is rallying, they imagine strength in the simplest sense: more demand, more trust, more power. But in reality, a currency rally only tells you where money is running from, not where it truly wants to stay. A rising dollar does not automatically mean the US economy is healthier. It often means other economies look riskier at that moment. Currency markets are relative by nature, and this is where most interpretations fail. The dollar can rise even when the United States is adding massive debt, running persistent deficits, and facing long-term structural pressure. What drives the rally is not belief in perfection, but comparison. Higher interest rates attract short-term capital because investors chase yield, not stability. When US rates rise faster than others, global money flows toward the dollar for returns, even if the long-term outlook remains uncertain. This creates a misleading signal. Charts point upward, confidence grows, and narratives of dominance return, but the underlying mechanics are temporary. Historically, this is where analysts make their biggest mistake. They confuse tactical flows with strategic trust. Strategic trust is built over decades through fiscal discipline, political stability, and global cooperation. Tactical flows are built in months through yield differentials and fear. The current dollar rally is heavily tactical. It is supported by rate spreads, safe haven reflexes, and the lack of a clear alternative, not by a renewed global commitment to dollar-based systems. This distinction matters because tactical strength fades quickly once conditions change. When rates plateau or global risk appetite shifts, the same flows that push the dollar up can reverse with surprising speed. The rally, instead of protecting the system, can amplify volatility later by concentrating exposure. History is full of moments where markets mistook temporary inflows for lasting confidence. Those moments usually end not with gradual adjustments, but with sharp repricing. Understanding what kind of strength you're seeing is the difference between being early and being blindsided. If the dollar's rise is based more on what it isn't rather than what it is, then the real risk lies in assuming that today's rally guarantees tomorrow's dominance. If dollar strength today is driven by comparison and short-term yield rather than long-term trust, then what happens when those advantages disappear? And how quickly can confidence unwind when the flows reverse? Every major currency that once dominated the global system had a moment when it still looked strong on the surface while its influence was quietly eroding underneath. And the US dollar is not exempt from this pattern. To understand why rallies can be deceptive, history offers uncomfortable parallels. The British pound remained a global reserve currency long after Britain's economic dominance had begun to fade. Economic dominance had begun to fade. Even after World War I drained the UK financially, the pound experienced periods of strength because trade habits, financial infrastructure, and global trust do not vanish overnight. Investors continue to treat the pound as reliable not because the numbers justified it, but because the system was familiar. This created a dangerous delay between reality and recognition. The same pattern appeared with the Dutch guilder in the 18th century, which remained widely used even as the Netherlands lost geopolitical influence. Currency dominance ends slowly, then suddenly. The transition is rarely announced. It unfolds in quiet adjustments. Bilateral trade agreements, diversification of reserves, and subtle changes in settlement practices. By the time markets react visibly, the shift is already advanced. This is why late-stage strength is not reassurance, it is often camouflage. The dollar today benefits from decades of institutional momentum, global trade invoicing, reserve holdings, and financial plumbing built around it. These structures create inertia, but inertia should not be confused with immunity. History shows that once alternatives reach a critical mass, transitions accelerate. The pound did not collapse in a single year. It lost relevance gradually, then rapidly after key shocks. For the dollar, those shocks may not come from a single event, but from accumulation, debt growth, political fragmentation, and the slow diversification away from dollar reliance. Rallies during these phases serve a psychological function. They reinforce belief in continuity and delay hard conversations. But belief is not the same as sustainability. The lesson from history is not that the dollar will suddenly disappear, but that its role can change faster than public perception once tipping points are crossed. And those tipping points are often invisible while the charts still look healthy. If past reserve currencies appeared strong right up until their influence began to fade, then what signs are quietly forming today that most people are ignoring because the dollar still looks dominant? Interest rates are one of the most powerful illusion makers in modern finance, and they play a central role in why the dollar looks stronger than it actually is. When the Federal Reserve raises rates aggressively, it sends a signal of control and confidence, but that signal often masks the reason rates had to rise in the first place. High rates attract global capital because investors chase yield, not because they believe the underlying system has become healthier overnight. This creates a mechanical demand for dollars as global funds rebalance toward U.S. assets, pushing the currency higher. But this kind of strength is borrowed from the future. Elevated rates increase the cost of servicing debt, slow domestic growth, and put pressure on governments, households, and corporations simultaneously. Historically, periods of high rates often coincide with late-cycle stress rather than long-term stability. The danger is that markets interpret policy tools as proof of strength instead of emergency measures. The dollar's rally becomes a reflection of policy tightness, not structural resilience. This distorts perception. A strong currency driven by rates can actually weaken the economy it represents by hurting exports, increasing financial strain abroad, and amplifying global imbalances. For emerging markets, a stronger dollar raises debt burdens and drains liquidity, creating stress that eventually feeds back into the global system. This is how currency strength can become self-defeating. The more the dollar rises on rate differentials, the more fragile the global environment becomes, increasing the likelihood of shocks that force policy reversals. Once rates peak or expectations shift, the same mechanism that lifted the dollar can unwind rapidly. History shows that currencies supported primarily by monetary tightening rarely maintain dominance without deeper fundamentals. Rates can buy time, but they cannot buy trust indefinitely. When confidence rests on policy rather than productivity and balance, strength becomes conditional. The critical question is not whether rates can keep the dollar elevated today, but whether the system can sustain the consequences of those rates tomorrow. If high interest rates can temporarily lift the dollar while quietly increasing long-term stress, what happens when the cost of holding this key strength becomes too heavy for the system to bear? One of the most dangerous side effects of a strong dollar is how effectively it hides the scale of debt accumulating underneath the system. When a currency rises, it creates the illusion that obligations are manageable, that confidence is intact, and that the system can continue operating without major adjustment. But debt does not disappear just because the currency looks powerful. In fact, a strong dollar can encourage even more borrowing by lowering perceived risk and delaying fiscal discipline. The United States has been able to sustain expanding debt levels largely because the dollar's reserve status reduces immediate pressure. Global demand absorbs issuance, markets remain liquid, and refinancing appears routine. This creates a feedback loop where strength justifies expansion. Historically, this is a familiar setup. Late-stage dominance often coincides with peak leverage, not restraint. The problem is not debt itself, but scale relative to growth and productivity. When debt grows faster than the real economy, strength becomes cosmetic. The dollar's rally helps mask this imbalance by keeping borrowing costs relatively stable in global terms and reinforcing confidence among foreign holders. But confidence based on convenience is fragile. Once doubts emerge about long-term sustainability, the reassessment can be swift. A strong currency also increases dependence on continuous inflows. If demand ever weakens, refinancing pressure rises sharply. This is where history becomes unforgiving. Systems built on perpetual rollover rather than reduction eventually face moments where trust becomes conditional. At that point, markets stop asking whether debt can be managed and start asking who bears the cost. Rallies during these phases are not signs of resolution. They are pauses before adjustment. The danger is not that the dollar will collapse, but that the system supporting it becomes increasingly sensitive to shocks. Debt hidden behind strength creates vulnerability, not resilience, and the longer that strength delays reform, the sharper the eventual correction tends to be. If a rising dollar allows debt to grow quietly without immediate consequences, what happens when markets finally question whether that debt can be carried forward? And who absorbs the shock when confidence shifts? While public narratives focus on the dollar's strength, the most important reactions are happening quietly, far away from headlines and market charts. Governments and central banks rarely announce shifts in currency strategy with dramatic statements. Instead, they adjust slowly, pragmatically, and often invisibly. Over the past decade, many countries have begun reducing reliance on the dollar, not out of rebellion, but out of risk management. Trade settlements are being diversified, bilateral currency agreements are expanding, and reserve compositions are being rebalanced incrementally. None of these moves alone threaten dollar dominance, but together they reveal a subtle change in behavior. This is how transitions actually begin. History shows that reserve currencies lose influence not because others reject them outright, but because alternatives become good enough in specific contexts. Countries exposed to dollar volatility, sanctions risk, or tightening liquidity have strong incentives to reduce dependence where possible. The dollar's rally can even accelerate this process by increasing costs for dollar-based borrowing and trade. Ironically, strength encourages hedging. Central banks do not need to abandon the dollar to weaken its influence. They only need to reduce marginal reliance. Each diversification decision slightly lowers structural demand. Over time, these small adjustments compound. The challenge for observers is that none of this shows up clearly in short-term price action. Markets respond to flows, not intentions. But policy operates on horizons longer than market cycles. When global systems begin preparing for scenarios where the dollar is less predictable, the foundation of dominance slowly shifts. This does not mean replacement, it means optionality. And optionality is powerful. The moment credible alternatives exist, trust becomes conditional. The dollar still dominates because it has no equal substitute. But the direction of preparation matters. Strength today does not stop others from planning for tomorrow. It may even motivate them. This quiet rebalancing is not a crisis signal. It is a warning phase. By the time it becomes visible in markets, the groundwork has already been laid. If countries are quietly reducing reliance on the dollar while markets focus on its rally, how long can dominance last before preparation turns into real structural change? Markets are excellent at measuring movement, but they are notoriously poor at sensing transition, and this is why major currency shifts almost always surprise the majority. Price charts reflect what has already happened, not what is forming beneath the surface. By the time a structural change becomes visible in market data, the decision-making that caused it is often years old. This lag creates a dangerous illusion of stability. As long as the dollar continues to perform well on charts, investors assume dominance is intact. But markets do not price slow preparation. They price sudden realization. History confirms this pattern repeatedly. When the British pound began losing its reserve status, markets did not gradually adjust valuation year by year. The repricing came in bursts, triggered by events that forced recognition of realities long in motion. The same dynamic applies today. Dollar strength driven by short-term flows can persist even as long-term confidence erodes quietly. This disconnect is why analysts who rely only on price action often miss regime shifts. Currency dominance is a political, institutional, and behavioral phenomenon before it is a market one. Charts react last. By the time markets adjust, options have already been exercised by governments, corporations, and institutions. This is why over-reliance on visible indicators creates false security. A stable chart does not mean a stable roll. It means uncertainty has not yet been forced into visibility. When it is, adjustment happens quickly because markets move faster than policy. This creates sudden volatility that appears irrational but is actually delayed logic. The danger zone is not when prices fall, but when they refuse to signal risk while systems quietly adapt. For the dollar, this means that continued rallies do not invalidate concerns. They postpone recognition. And postponement tends to increase the size of eventual moves. The longer markets lag reality, the more violent the correction when alignment finally occurs. If markets only react after structural shifts are already underway, then what signs exist outside the charts that could reveal where the dollar is actually heading next? As we approach 2026, several pressure points are quietly converging that could redefine the US dollar-S role in the global system. The first is domestic debt. The federal deficit continues to expand while entitlement obligations grow, creating a structural imbalance that cannot be fixed with short-term rallies or higher rates. Second, global inflation and geopolitical tensions are increasing uncertainty in markets, forcing nations to explore alternatives to the dollar in trade and reserves. Third, the rise of digital currencies and regional clearing systems is creating optionality that did not exist a decade ago. These factors individually are manageable, but together they compound risk. The combination of high leverage, geopolitical fragmentation, and alternative currency development creates a scenario where the dollar may remain superficially strong while underlying vulnerabilities accumulate. Importantly, these pressure points are mostly invisible to everyday market participants. They manifest in subtle shifts, changes in reserve allocations, increasing bilateral trade outside dollar channels, and cautious hedging strategies by global investors. This is the classic pattern of late-stage dominance. Strength today masks risk tomorrow. Analysts focused on rallies often miss these structural signs because they are intangible, requiring deep knowledge of fiscal policy, trade flows, and international finance. For investors and policymakers, the lesson is clear. Understanding the trajectory of the dollar requires looking beyond price charts and headlines. One must observe systemic adjustments, global hedging behavior, and emerging alternatives. While the dollar may continue to rally in the short term, these pressure points quietly create the conditions for accelerated change. The key is timing. The sooner these vulnerabilities are understood, the better one can anticipate the eventual pivot in influence. Ignoring them risks being caught off guard when the rally ends, and the structural weaknesses finally assert themselves. If the dollar appears strong now, but pressure points are building invisibly, what events or signals in 2026 could finally trigger the hidden shift, and who will feel it first? When structural weaknesses accumulate beneath a superficially strong dollar, the consequences are rarely evenly distributed, and understanding who benefits and who suffers is key to interpreting global economic dynamics. On the winning side are nations and institutions that have already diversified away from heavy dollar reliance. Countries investing in alternative reserves, regional trade agreements, or digital currency infrastructure can gain leverage if a shift accelerates. Large multinational corporations that hedge exposure to currency risk also stand to benefit, as they can operate flexibly across fluctuating exchange rates. Meanwhile, the losers are often the most exposed to dollar dependence, particularly emerging markets with dollar-denominated debt, countries heavily reliant on trade invoiced in dollars, and domestic borrowers within the United States who face rising real interest costs. Even advanced economies are not immune. Sectors dependent on exports may struggle if the dollar remains elevated while domestic competitiveness weakens. Investors who rely solely on the narrative of dollar strength are also vulnerable, as short-term rallies can mask underlying risks. Historical examples reinforce this pattern. When the British pound lost influence, those heavily reliant on pound-denominated contracts experienced losses even before markets visibly adjusted. Similarly, the US dollar's hidden vulnerabilities mean that early recognition and strategic positioning will determine winners and losers long before any public panic occurs. The imbalance creates opportunity for foresight and risk for complacency. Observing who is hedging, who is diversifying, and who is ignoring structural weaknesses is as important as monitoring the rally itself. Understanding these dynamics allows investors, governments, and even everyday citizens to anticipate the ripple effects of a currency whose strength may be masking growing fragility. The question is not if consequences will appear, but when they will begin to materialize, and how prepared different players are to respond. If some players are quietly preparing while others remain exposed, then who will feel the real impact first? And how can observers detect the early signs before it's too late? For young investors, students of finance, and everyday citizens, the hidden shifts in the dollar's power provide invaluable lessons about preparation, observation, and understanding risk beyond the obvious headlines. The first lesson is that short-term appearances are often deceptive. A strong dollar today does not guarantee stability tomorrow. Learning to read beyond charts, analyzing macroeconomic indicators such as debt levels, trade balances, and reserve diversification, and understanding geopolitical trends can offer foresight that typical market commentary misses. The second lesson is diversification, not just in portfolios, but in perspective. Those who rely solely on dollar-based investments, or who assume global systems will remain unchanged, risk being blindsided by systemic shifts. Global history demonstrates repeatedly that adaptation comes to those who notice incremental changes and prepare strategically. Third, understanding the cause and effect relationship between policy decisions, market reactions, and structural vulnerabilities is crucial. Monetary tightening, interest rate differentials, and central bank interventions may temporarily reinforce confidence, but they rarely address underlying imbalances. Observing these interactions builds intuition for when rallies are masking risk. Finally, timing and patience are just as important as knowledge. Awareness allows early positioning, but recognition of when action is necessary distinguishes the proactive from the reactive. Financial literacy combined with historical awareness creates a unique advantage. the ability to anticipate shifts while others remain focused on superficial trends. These lessons are not just academic, they are actionable. From personal savings to investments, from understanding geopolitical risks to planning for inflation or currency exposure, knowing the invisible pressures behind apparent strength can protect wealth, guide decisions, and sharpen strategic thinking. In the context of the US dollar, these lessons encourage individuals to recognize that strength on the surface is not always stability beneath, and that early understanding can be the difference between opportunity and vulnerability. If reading beneath the surface can reveal hidden risks and opportunities, then how can individuals start building this insight today before the next major shift catches the unprepared off guard? The rise of the US dollar today may seem reassuring, but the story underneath shows a different reality: structural weaknesses, global diversification, and subtle pressure points that are quietly reshaping influence. While we analyze trends, it's important to remember that dominance is never permanent. History proves that even the strongest currencies eventually face shifts that catch the unprepared by surprise. Observing these signals, understanding the balance between short-term rallies and long-term stability, and preparing strategically are what separate those who navigate global finance successfully from those who rely on surface appearances. If you found this video valuable, check out our previous video. The dollar didn't collapse. It slowly lost power. A financial history most people miss. To see how historical currency shifts offer lessons for today, don't forget to subscribe for more in-depth financial analysis, comment below with your thoughts on the dollar's future, and share this video with anyone who wants to understand the hidden forces shaping global finance. If the dollar's rally hides risks that most people miss, then how prepared are you for the shifts quietly forming behind the scenes, and which trends should you watch next?